then that you can't have. So please, this is just a reminder, the sooner the better, because then you can start actually analysing them, and there's more opportunity to ask any questions throughout this semester. But you would need to contact Helen, and her email, sorry it's really small, is just there. But if you can't find that, you can, I think it's over here. Yeah, so all the, mine and Helen's information is here, so if you want to contact either one of us. Okay, so just needed a reminder of that. Today we've got some small, just quite easy questions, where I want you to work in groups in the tables that you're sat in, and we're going to look at 2 different companies, and I'll hand this out now, and then we'll have a discussion about it. Yeah, it's that one, but I've just changed it a little bit. We have 3 questions to answer. The first one is looking at 2 companies in the same kind of industry, so both in retail. One, company X, is a little bit more luxury and high-end than company Y, which is cheaper clothing and less expenses. So given what you guys know already about ratio analysis, what I want you to do is compare both companies based on the information that we have. So there's not a lot there. How might their percentages differ? So for example, to get you thinking, would company X have a higher gross profit percentage perhaps? And who would have a higher net profit percentage? So obviously one doesn't include expenses, one does. So it's thinking about them. Also liquidity. So will one have more current assets than the other? So a couple of points per table. And then question 2 is specifically looking at IAS 1. So the requirements for financial reporting, and it's asking you what information needs to be included in the notes. So not the whole standard, just in the extra notes. So I'll show you, for example, if I think I've got Marks and Spencer's, where did I put you? Oh, we'll just use Aston Martin for now. So if I scroll all the way down to find them. So you've got your financial statements here, which we have to have. What I want to know is not including the cash flow statement or the financial position, what needs to be included in the notes, okay? So that extra supplementary material that IAS is asking for. So maybe 1 or 2 points. I'm happy for you to go back and have a look at the lecture earlier this week where you looked at that. And by all means use the internet to have a little Google. So what does the standard ask for to be included in these notes that every company has to produce? And then the last question, I'd like you to look at the advantages and the disadvantages of principle-based accountancy, so IFRS versus, say, for example, the US GAAP. Okay, so let's spend about 25 minutes in groups. Then what I'll do is come round and ask every table to contribute, and we'll start going through what we know. So the first question is asking how them companies' ratios might differ. The second question is asking about IAS 1 requirements, and the third is about advantages and disadvantages of principle-based accountancy, so IFRS, IAS, things like that. Okay, so definitely work together. This is a group kind of task, talk amongst yourselves. Okay? The layout of each statement, so you've got your statement of profit and loss with your revenue, cost of sales, gross profit, then expenses, net profit. Statement of financial position, non-current assets, so your buildings, land, things like that. Your current ones, which include them trade receivables, cash, large loans, and then trade payables for your current. That might help you when you're thinking, well, how would that ratio be impacted? So if you're looking at gross profit, you know it's going to include that cost of sales. So maybe one might have a higher cost of sales than the other. We don't know that, but you need to think which one would. Or, for example, company X, is it company X, pays a lot, has a lot of employee costs, which are going to come underneath that admin cost, whereas company Y probably has less expenses. So how will that impact each of their net profit? And then for liquidity, we're talking about these current assets versus these current liabilities, okay? Just to give you a little bit of a clue in case you didn't bring the ratios with you, okay? It might help a little bit just being able to see what is impacting what, okay? Awesome. So I'll start with this table here. What do you think is the first thing that you would see a big difference in? Yeah, no, yeah, completely. So, go on, sorry.
Yeah, and also they might pay less for their rent because they're mostly in like outer city areas and not in the expensive city centers.
Yeah, I completely agree. Did anyone else think that in terms of their net profit percentage, that company Y, so this one would have a better net profit percentage because they have less expense? Did you guys agree? Yeah, I definitely think that is a good analysis there. You know that, I mean, in terms of that, company X will most likely have a higher gross profit, but because of all that expenditure to do with their employees and, like you said rightly so, the rent of the premises where they operate from, their net profit may be significantly lower than company Y. Okay, brilliant, thanks. What about you guys at the back in terms of their liquidity, so maybe how their assets differ?
So company X might have bigger assets.
Yeah?
Because they offer generous credit terms, which increase their account receivables.
Yeah, exactly, great. But what might that other asset impact? So if you have more trade receivables, what have you got less of?
Revenue.
Yeah, or cash even. Yeah, definitely. So although it's great that you have a high trade receivables, and generally speaking, that's going to increase your revenue, customers are going to feel that they want to return because essentially they don't have to pay for these luxury items today, and that's good. But what happens if you're not getting cash straight away? What might you do to compensate for that? If I'm not receiving cash, what might I take out?
Bank.
Yeah, so loans. So do you think their liabilities might be higher than company Y? Yeah, definitely. So for company Y, obviously one of the things that is very significant is they encourage their customers to pay immediately, which they'll have more cash, whereas company X, like you said, will have a lot more trade receivables for their assets, which is good. You both have high assets, but realistically, in terms of their liabilities, they are going to have to take out maybe a loan or an overdraft extension to cover any payments that they need to make until they receive that cash from their trade receivables. So that was a great analysis. Anything else? Did you notice anything about that? Would you say that one's riskier than the other? What do you think? Is one more, if you looked and you were planning to invest, which one might pay you a dividend out first, for example? Which one has more cash? Yeah, so although company X is a very, I mean, it sounds like it's been going on for a while, it's an old established retailer, they clearly are making profit. and they're clearly running quite well. But in terms of risk and their liquidity and the likelihood of us getting a dividend payment, we're probably going to get it from company Y because they are just a little bit more solvent. They have more money in the bank. So although, and I think the main thing I want to tell you here, just hypothetically speaking, we were given the percentages and none of this information, we might be interpreting that companies or these companies very differently to how we currently are. So when you come to your assignments, you need to have both kind of analysis there. So being able to look at the context and understand it, and then look at the percentages and interpret that, yeah?
But actually, we thought that company Y might have a lot of liabilities as well because it's newly established, so they might have to take loans
To actually start
their business.
But what maybe they didn't take a loan, what else could they have used to finance them?
Equity.
Yeah, brilliant, and that's good for a start-up company. So again, we're unable to, that's a good analysis and thinking a little bit more in depth about, well, you know, it's a start-up company, how would they have financed it? So that is something that when it comes to your companies, when you look at them in the assignments, you might want to find out how long they've been on the FTSE for. You might want to see what kind of finance they have. Do they have more debt than equity, or is it quite a nice split? So it's all, the context of company analysis is just as important as that ratio analysis. And using one and then the other without comparing can give a very different image of a company than what you see when you combine both ways of analysing. Okay, brilliant, thank you guys. So I'll come to this table next. In terms of question 2, what kind of things would you expect to see in them company notes? So you have your statement of profit and loss, your statement of financial position, and then usually you have lots and lots and lots of notes. What would them notes help explain in terms of information that isn't available in the accounts? I'll come back to you guys. What about you guys, in terms of the notes, additional notes in a company's accounts, what might they explain in more detail? Yeah, so I mean so payment period, did you say? Yeah, so so if we've got receivables, they tell us more about how long we're receiving that money for or how long we're waiting for it. Definitely. This table?
Well, accounting policies in general.
Brilliant, yeah, so accounting policies. I'm just going to take this for 1 second. If we are given a statement like this and we aren't told, oh, well, we use generally accepted accountancy policies, or, oh, we use IFRS, and which kind of measurements, fair value measurements, we are going to struggle to understand how they've done their work. So yeah, definitely, they should be being very honest about the accountancy policies that they've used. Because last year they might not have used IFRS 15, which is a new standard for this year. They have to use it this year, so they'll have to draw comparison. They'll say, well, we haven't used this last year, this is what it would look like if we did. So they need to be really clear about that. Anything from this table, what else might they include? So accountancy policies. What might they want to explain to us? So when you've got them numbers, what else might they want to explain? So if you were an investor and you looked at the statement of profit or loss and you saw revenue and this number, is there anything that you would want explained about them numbers? Yeah, so maybe what's included in the expense?
Employee cost, electricity,
Yeah.
customer service.
Yeah, so segmental information. So if you have on a financial statement, and let me show you an example so you... Oh. Okay, so yeah, using Aston Martin again, let's go up to their cash and their comprehensive income, and I'll zoom in so you can see a little bit better there. So we have our revenue figure, quite a nice one, over £1 million, but that's all we know. We have no idea what is included in that revenue. We don't know how they've measured that revenue. We don't know how regular that revenue is being brought in. Is it equally brought in throughout the year? Are we recognising revenue that we haven't received yet? Things like that. And the same with expenses. So we've got selling and distribution expense and admin expenses. Included in that administration expenses are salaries, director remuneration costs, all these other expenses, so rent and things like that. You as investors or analysts will want to understand, well, it's increased. Why is it increased? So do you see these little notes? This little note here, 3, 6, 5, and so on. They're the notes that you have to include. So I'll show you what I've written down so you can see this. So yes, so you need information about their measurements. So how do this company measure their assets? Are they using a certain valuation technique? What kind of information is required by the international standards and accountancy policies? That's very important because if they've changed, or say for example they didn't use international standards last year, remember then accounts need to be we need to be able to compare on an annual basis, so that needs to be explained. And don't worry about writing this down, I'll be putting it on Blackboard next week. And then any additional information that is relevant, so I'll go back and show you the Aston Martin accounts and give you an example. So let's scroll down. Okay, yes, so the notes. So the first note that they've got is basis for accountants. They're talking about the fact that they're using adopted IFRS. So we know what accountancy policies they've used throughout the year. They'll also talk about different ways of different ways of measuring. So if I scroll down, let's see if I can find a good one. So this is still accountancy policies. As you can see, they're quite important. Yes, so they're talking about new accountancy standards that they've got this year. So right there at the top, this is brand new for last year, the revenue from contracts with customers. That got brought in mainly because there was a couple of quite big public accountancy scandals last year in the UK and in the US and probably globally, so they brought that one in. And the share-based payment was amended as well. So they have to demonstrate or tell us that that has happened, because that's the whole point of these accounts, that they're true and they're transparent and we're able to make good investing decision making based on what they're telling us. So you will find that when you guys start your assignments and pick your companies, the financial accounts, so the cash flow, the statement of financial position and profit and loss, maybe 5 pages long. And then the notes will be 50 pages long. There's a lot of information there. So yeah, they're very important. So I've given some examples, and again, I'll send these out, so don't worry if you write them down. But again, just saying how this is a brand new standard. If they used it this year, they need to explain how, maybe if they had have used it last year, how it impacts on their statements. Measurement information, goodwill. Goodwill is such a vague concept. How do you measure something like that, like reputation? So it's all about them kind of important points. And then that segmental information, so really getting into the nitty-gritty and the detailed information that is being tied up in that administration expense. Because it's just not one administration, it's loads of different expenses consolidated into one. So we, as investors, employees, as directors of that company, need to understand where money is being spent and so on. Okay, brilliant. Lastly then, what about our principle-based accounting? What's good about using principle-based accountancy? I'll come back to this table. So what's good about using principle-based?
They can have a comparison with the last year or other companies.
Yeah, definitely. It really allows compliance and understanding with them statements. And one of the biggest focuses is having that comparability, so for future investors. Table at the back here. A good thing about principal accountancy.
It's more flexible.
Brilliant, yeah, definitely. A lot more flexible. Has anyone heard of the saying, rules are there to be broken? Yeah, right? So it allows more flexibility, but there's a downside to having very flexible standards. Can anyone tell me what that might be?
I think the way they interpret
Definitely.
it's a disadvantage.
Yeah, 100%. So let me use a prop. I'll use this again. This is my standard, okay? One standard, and I am auditing, or I'm auditing 5 different companies. One in aerospace, and one in food manufacturing, and one in so on and so forth. And I have to apply this standard to every single one. That's going to differ, and it's going to be really difficult, and I need to use my human judgment and my interpretation of how that fits. And that's good that it's flexible, but it's also a challenge that it needs to be the same for every company, and that's when it gets quite complicated. So yeah, brilliant. So again, I'll show you what I said, sorry. Definitely provides flexibility. We want flexibility. One of the biggest pros, I think, or the advantages, is this. It allows that harmonization across countries. Now, I know you mentioned comparability, and that's exactly one of the best parts about that is that harmonization. So you've seen companies on the FTSE 250 or the 100, and I mean, they don't just operate in the UK. They operate in the US, they operate in African countries, they operate in China, they operate in Australia, and they have to consolidate it all down into one. Now, the majority of them countries all use IFRS, or International Financial Reporting Standards, so that means that their operations across the globe are easily consolidated into one, allowing that comparability. So yeah, I think this idea is a controversial one, I would say, because the people who create the standards want the whole world to use this one standard. So you could say it's a little bit interesting. It's a good topic to think about. But yeah, definitely in terms of what I said, a disadvantage for the principle base is it may lead to uncertainty. Because of that flexibility, different organizations operate differently. So it's not always black and white, and you need to really work hard to be able to interpret it the way that the standard wants you to interpret it, which we're all humans, accountants are humans, we make mistakes. And it can still be read as a rule, so this is quite a hard one to explain, but if it's on a piece of paper and it's written down, research has suggested that as humans we will read something as it is, and we're not very good at reading analysing it, what it's meant to be. So there's this saying called paying lip service. So you're doing what you think is right, but it's not what was actually meant to be. So there's a risk there that
what you think the standard is telling you to do, but you're not, you're doing it wrong. And that happens quite often. People aren't great at interpreting things in general. Okay, so for next week, what we'll be doing, what I'll be doing, there's no preparation, so just come in, I'll give you the work. Yay! And we'll start actually analysing 3 FTSE companies. So I'll select them, and we're going to look at income statements next week. So it's ideally if you can start, or if you haven't already, pick the company that you want for your assignment. And then I'll be bringing in different companies and getting you to think of how you would interpret it. So even after the seminar, you could then go and do the same interpretation on your company. So we're really starting to get into the analysis of FTSE 100 and 250 companies to really get you going on your assignment. So that'll be for the next 3 weeks. We'll do income statements next week, statement of financial position the week after, and then cash flow statements after that. So definitely try and pick your companies if you haven't done so already. Have a fabulous weekend, and I'll see you next week.